Before we start, let me introduce myself real quick, and then the panelists can also introduce themselves. My name is Nils Veenstra. I'm the co-founder of Beacon, and we run events like these and larger worldwide. And usually, Michael has me moderate a vertical application panel around healthcare and blockchain or supply chain blockchain. This is the first time I'm doing an exchange panel. Looking forward to it and get some free education out of it as well. Before we start, I'd like to ask you if you please can state your name and also how you actually got into the blockchain space to begin with, before you get to your company.
Thank you. My name is Shawn Sloves. My name of the company is Velocity Ledger. Got involved with blockchain probably around end of 2011, 2012. We had done a global deployment of exchange for 2.5 years called Atlas. What fascinated was that we build market center technology for equities, options, futures, FX for big banks, exchanges, ATSs, and we sort of saw the writing on the wall where it was all going with cryptocurrency and blockchain. So we've been involved since, and we've never looked back.
Hi, I'm Josh. I got started in crypto back in 2004, 2005, but by which I mean cryptography, not cryptocurrencies, because there was no such a thing. I ended up following my first passion, which is trading. But given kind of the way things shook out in cryptocurrencies and to some degree to Ethereum's credit, the growth of the space, blockchain became kind of a digital asset, and then it became more familiar with traditional assets and traditional markets and normal cap markets, and that's sort of how I got back involved in the blockchain space.
Yeah, my name is Miko. I'm with Evercoin exchange, and basically my co-founder of the exchange dragged me into crypto. Didn't know much about it, but I've been in open source software for maybe 25 years, so it's pretty familiar.
Thank you. I have one. Okay, my name is Feng. I'm a Chinese, but I'm living in Brazil. Now I'm the partner of CoinBene. Now it is in the top of the international exchange. Now we have our business, international exchange service, and in some country, for example in Brazil, we are the only have the fiat access the international exchange out there.
So Bo, let me actually start with you, because you have the microphone in your hand anyways. Okay. So your exchange is based in Singapore, correct?
Yes, our company, we register in Singapore.
Okay, so if you want to expand, if you expand from Asia to Brazil and also to Europe, what are the major pain points for you to actually expand the company?
Good question. Nowadays for us, actually we come from, our company, we come from China. We have our development in Asia, now in Japan, in Korea, in Malaysia, now in Brazil. So the main, how to say, the pain points for us, the first one is the local regulation. Because for us, comparing with the top three, the exchange, now our strategy, we would like to cooperate with the local regulator and to develop a more local market. For example, in Brazil, so with the local operation, we suffer a lot about the local regulation. So we are trying to solve it, but until now, the situation is very well. We have the cooperation all of the top banks. The situation continually in Japan, in Korea. So I think until now, it is the most important things.
All right. Shawn, let me go to you for a second. You work with, actually, I'll give you my mic as well. Okay. So you have been working with centralized markets for years. How do you use blockchain in this field?
Excuse me. So in terms of the centralized markets, the way we basically had operated or over the years is you have a central limit book and you have centralized clearing. What we see is happening is blockchain and the notion of blockchain settlement being decentralized is disenfranchising, removing the middle layer. So if you look like in Canada or the US, you'll have a central clearing group when it's CDS in Canada or DTCC in the United States. And typically what happens is if you trade on a centralized matching facility or a club or a central market, it will go to a centralized clearing who will be the counterparty between the two entities. So what blockchain is really doing is disenfranchising that piece. The other piece is what typically happens in the United States is that you don't know the beneficial owner. Same thing as Canada. So the way with blockchain or crypto security digital assets, the assets are held in an individual name. So what's basically is happening, you're going to have centralized trading in a market like an ATS or an exchange. You'll have a settlement system, and basically you'll have settlement between the two participants directly, and you'll have transfer of ownership, and the records will be the individual. So it's really just getting rid of the middle layer, and it's really benefiting the end user. So if you're issuing a digital asset, you'll basically, if I'm Apple and if I have shareholders, rather than my shareholders being represented by brokers and middlemen, basically my shareholders will have direct input in understanding who owns my assets, and the middle layer will be gone.
And Josh, I mean, you were about last year you were raising money for your company, building a centralized exchange. I would assume that back then most investors were scratching their heads, saying, "Why don't you go for a decentralized exchange?" What do you see as main differences between the two? Why do you building a centralized exchange?
So I think in the last 24 hours on BitMEX, $1 billion has traded. And the last 24 hours on decentralized exchanges, $2 million has traded on all of them. Like, more will trade on BitMEX while I'm talking than will trade all day on decentralized exchanges. So yeah, like, they might someday be a bigger part of the market. There's definitely some futures we could live in where, like, there's hyper tokenization and, like, there's millions of tokens and it's too difficult to have liquid active markets in all of these tokens. And we might see some sort of, like, automated decentralized market makers take up some of that slack. But as someone who's spent their entire career in traditional capital markets and understands the value of liquidity, like, the true product of an exchange is liquidity, and none of the decentralized exchanges can really deliver on that promise.
Miko, do you have anything to add to that?
Yeah, I mean, the thing that's terrible right now in crypto is that we are totally stuck between a rock and a hard place, right? Because what he's saying is absolutely true. There's a great project on GitHub that tracks 253 decentralized exchanges, right? So we have 253 of these things, and none of them are producing even a rounding error's worth of liquidity. And by the way, like, there's an entire mindset of, oh, but they'll just get faster, right? That mindset is a broken mindset. Like, it doesn't matter how fast the chains get. They're not actually going to ever outrun centralized exchange. And since they won't outrun them, liquidity will always flow towards them, right? Because what you don't want to do is put a large order on a DEX and have someone on a centralized exchange front run your order, right? So to me, like, nobody's going to put a large order on a DEX unless they're money laundering, in which case they're taking advantage of, like, anonymity, which they're not going to get on a centralized exchange. So to me, we're really stuck. And the reason why I'm saying we're really stuck is that centralized exchanges, the custodial centralized exchanges, are perpetrating all kinds of, like, evils. And, you know, and really it's just a re-injection of a non-regulated bank entity into a peer-to-peer electronic currency or asset system, right? So by re-injecting this central player, we're losing the majority of the benefits of having that in the first place. So, you know, I really feel like at the moment, exchange is a deeply broken space.
Bo, do you have anything to add to that?
As my opinion, yes, we are talking about a lot about the decentralized or centralized from our point of the view. First one, we saw the technical possibility that decentralized could solve a lot of the problem, a lot of the headache from the exchange side, for sure. But now the commercial reality is not our first priority, because as the business, we must to think about the cost and what is we could implement now, right? So I just mentioned, for example, for exchange, the first one, the crypto asset for us is very important, right? So nowadays, for example, in our platform, we have 140 the token at there. There has more bigger possibility that we could involve more assets, even some traditional assets in our system. But if we have if the decentralized, the system could accept by the traditional institutions, we have more possibility to do that. But until now, we haven't found the good solution. The second one is about the liquidity. Just like Mike has mentioned, now, for example, the liquidity from the exchange, totally different. But it's difficult to identify who is the truth, who has the true the liquidity, who has the fake. So for us, if there has the fair competition in the market, I think the decentralized solution could be one solution for the market. But who will make the first trial? It doesn't mean who will win in the last, right? The third one, about the user side, I think decentralized for sure could improve the safety, like these kind of the things. But until now, as an exchange operation, the most priority the security issues is come from the, like phishing, like this kind of from our user side. It's not come from this decentralized or this kind of could solve.
Right. Miko, actually, you mentioned speed. I know that the company that Josh works for, LXDX, brands itself as a very fast exchange. Why is speed important, Josh?
Performance is really critical for an exchange on two fronts. One is just there being enough reliability for like available liquidity. But I think the other, which is a little bit more subtle, is that most of the liquidity on exchanges comes from market makers. It's not just that there's randomly orders that just happen to be there resting. It's market makers. And for market makers to be successful at their business, it's all about risk-adjusted returns. And so they're going to show you a price, but if your exchange is super sluggish and you can't cancel the order for 20 seconds, they're going to end up getting filled at not their intended price, which means that the market maker has to bake in more edge and give you a worse price. And so as a consumer of a quote, you get a worse quote with lower quality liquidity because the market maker has to adjust his price for you. And this is dead weight loss. Like, this is just dead weight loss for everyone involved in the system. So if you can build a very high performance system, like we've done, you do it in your own colo facility as opposed to doing it on some AWS servers that you rent hourly, you can really, you can make the entire ecosystem better for everyone here. Like, you can make it cheaper to trade, better prices, better everything, which enables like better returns for all the crypto funds and just like less just waste in the system.
Miko, so big thumbs up again. Do you have anything to add?
Yeah, I mean, if you look at, for example, if you go to ICE Exchange, the New York Stock Exchange, what you'll see is you'll see a rack, and then you'll see a bunch of traders have rented the adjacent rack. Some of them are using liquid nitrogen cooled crossbars to basically traverse 36 inches to get to the other rack because copper's too slow, right? So the thing that I think is really people don't understand about liquidity is that there's DEXs suffer from a speed of light problem, right? So, you'll always get front run because, really what happens with extreme liquidity is exactly what you described. So, I think that's really the nature of capital and liquidity flow. So, I think that's the nature of it. I think the biggest problem actually is not centralized versus decentralized. It's actually custodial versus non-custodial. And I think that's the biggest issue that we have. I think, once you have non-custodial, then 90% of the problems with centralization go away, and you get all the liquidity. So I think that's more the dimensional axis of relevancy.
I was just going to add a couple things. I mean, the whole notion of the problem with centralization is, we provide tech to a lot of the crypto exchanges out there. We also do traditional assets. Our systems are connected to groups like Citadel, Virtue, all the large HFT guys. We get measured less than 50 mics. Crypto, not so much. If you're under, 100 milliseconds, everybody's happy. But the problem what we see in the exchanges is that liquidity doesn't really exist in the majority of them. They basically refactor quotes. So really, they're just taking one limit book, refactoring another to another, and arbitraging. And the problem too is the arbitrage has to be in favor of the market maker. Any slippage on execution that doesn't work for the market maker will punish or penalize any particular exchange. So one of the problems, or one of the major problems, I mean, centralization is great, but it's really not centralized if you're taking quotes, refactoring on an exchange to provide liquidity. So, one of the things, and I'm not trying to plug myself, which is having experienced central markets and then decentralized markets. Problem with decentralization, you can't aggregate flow. If it's on a network and if it's on a messaging, advertising that you're a buyer and seller, there's no way you're going to build real liquidity, and you can never build real liquidity without market makers. So we know that doesn't work. But one of the things that, at least what we're trying to achieve, and I think the market over time will go there, 1,000 Bitcoin exchanges not connected doesn't work. 1,000 Bitcoin exchanges and even digital asset exchanges that are refactoring the same quote 50 times over doesn't work as well. One of the things, and I agree about the custody stuff, but it's not that simple. You do have to separate exchanges from holding and being custodian and having an independent party to allow them to trade freely, and everybody uses the same custodians, then it works much better, but that's going to take some time. I think BitGo is very useful there. But if you run a technology stack where you're basically exposing all your orders to all the other exchanges, so if we put up like 10 instances of our central limit order books, we basically will multicast or broadcast all the order information in real time to all the markets, and they'll be able to trade and hit with each other. The blockchain platform or the blockchain itself with the wallets will allow basically settlement between participants. So you have exchange A has a book, it's broadcasting all its orders exchange B, and vice versa. If the two exchanges trade, then you'll have the information on that exchange, who the wallets are, everything else. You can basically clear and settle the chain on the blockchain. You do need a central limit book, but I do think that it helps to chain the limit books together to build a better liquidity, and then you can use the blockchain solution for basically settling up between wallets and or custodians.
Are there any more questions from the audience? Let me actually see so I can see people. Are there any questions for the panel? Going once, going twice? No? All right, Feng, do you have any famous last words to take away?
Frankly speaking, now there has a lot of the discussion about the decentralized or centralized, these kind of the things. But my words is as the operator, as the company to operation in this market, we are more concerned about the commercial possibility, because we are working for the customer. We are working to solve the demands from the clients. So until now, for us, the first priority is not to define who is have more future, more advanced of the technically speaking, but which kind of the solution could help us solve the pain point from the clients.
Thank you very much. Michael, up to you.